Moving to the money laundering. Money laundering is the concealment of the origins of illegal obtained money, typically by means of transfers involving foreign banks or legitimate businesses. There are several processes, that is placements, layering, integration. Money laundering can be trade-based laundering, cash business laundering, bank, casino laundering, real estate laundering, so on. It is the illegal process of making large amount of money generated by criminal activity such as drug trafficking or terrorist funding appear to have come from legitimate source. The money from the criminal activity is considered dirty and the process launders it make it looks clean. 3 stages of money laundering. There are usually 2 or 3, depends on the launderer. First is the placement, second is the layering, third is the integration. Moving with the placement, there are 2 steps. First, transaction, which is undertaken by the criminal or by the money launderer to convert the illegal money into the legal money. The first transaction is undertaken by the criminal or by the money launderer. Money launderer is the person who is involved in this money laundering process, which is illegal activity, to convert the illegal money into the legal money. Second is the placement, which is done in the banks, stocks, market, gold, property, mutual funds, so on. Second is the layering, which is the subsequent transactions of converting the legal money into the further legality. Layering involves doing multiple transactions one after another, that is from bank to stock market, from stock market to gold, from gold to property, so on. Integration, which is the point of satisfaction where the criminal believes it to be the maximum limit, and this way the illegal money in the economy converts into the legality. This is the overall money laundering process. Now moving to the audit firm's role in the money laundering. Auditor appoints money laundering reporting officer (MLRO), who then receives information from peers, that is partners, assess on the basis of the evidence gathered, which then they pass it to the regulator. More time should be spent on the client identification process, which is client screening. Client screening is done when new client invites the audit firm. More time should be spent on the firm for gathering the information, knowledge about the company, organization, business, to identify whether any relevant areas which are prone to the laundering are there, and simultaneously if there, then they report it. Client screening is the process for understanding about the client, getting more details about the client's business, operations, so on, which is then discussed with the internal controls regulations. Avoid concealment. Well, auditor also looks after the internal controls being followed at the client, whether there are adequate measures which will be able to find out if there is any such events being there within the organization. No members should hide any information in respects of the money laundering. Everyone should cooperate and there shall be an avoidance of concealment. Audit firms should keep information records for 5 years.